I'm Charlotte McLeod with the Investing News Network, and here today with me is Ben Finegold, who runs uranium research at Ocean Wall. Thank you so much for joining me online today. It's great to see you.
Thanks for having me, Charlotte. No problem at all.
Of course. And as we know, our topic today is going to be uranium, which is of great interest to our audience right now. And as this interest builds, I've been trying to bring on new perspectives for people to learn about this sector. I wondered if you could start, for those who don't know, to talk about Ocean Wall and the work that you do there.
Yeah, of course. Thanks very much again for having me on. Ocean Wall are a niche alternatives focused investment house out of London. We work mainly in the metal space, but more broadly, we really cover areas of the market that have perhaps been unloved or maybe the dark corners of the market. Hence, a focus on uranium. Uranium, obviously, a previously fairly unloved sector, perhaps by investors, and maybe more broadly the nuclear sector. My personal role there is I run uranium research for them. We put out a weekly publication called Ocean Wall's Eye on You. I also work in the corporate advisory team. We do advisory services to clients in the metal space, in lithium and uranium, and a variety of sort of other special situation sectors. But that's what I do there. And as I said, I said to you previously that if anyone wanted to be added to our weekly newsletter, to please let me know.
Okay, perfect. Thank you for going over that with us. So as you mentioned, of course, uranium has been an unloved sector for quite some time. The market is now starting to pick back up. I want to begin with a pretty broad question and ask you where you see the market cycle at the moment.
Yeah, it's been, I've been saying throughout the year, it's been a pretty easy / very difficult time to cover this. Easy because news flow has been abundant throughout the year, and difficult because the parameters of the trade have changed multiple times. It feels almost on a weekly basis. My first week of this year was the Kazakhstan protest. Kazakhstan, 40% of global supply. And then by week 6, Russia had invaded Ukraine, which is 40% of global enrichment and conversion. So the parameters have really changed throughout the year. It's made it an exciting time to cover it, but also it's been fast paced. And as I said, the parameters have really changed multiple times just throughout the first 9 months of the year. I would sort of describe 2021 was really the year of price inflection. We saw Sprott come to market, sequester 40-odd million pounds of uranium, something that had never really been seen before. And then 2022 was predicted to be, and this has really come to fruition, it was predicted to be the year of term contracting. We're set for a record year in the term market. We've just had a call with UXC, and we've been reading various publications, and the general consensus is that we will be on target for 100 million pounds of term contracting by the end of the year. This will be the fastest, it was the fastest start to term contracting in a decade in the first quarter of this year. And similarly, it will be the most volume contracted in the term market in a decade. We're starting to see that in terms of Kazatomprom, for example. They're in preliminary discussions with utilities who are seeking supply through 2035. So these are 13-year forward contracts. So it's really anyone's guess where prices could go when you're going on that time horizon. But I guess if you're looking at it in terms of the cycle, you would maybe say we're in the second or third innings. I think for us really to hit that later stage stride of this cycle, institutional capital needs to come back into the sector in an even more aggressive way than we have seen. There's been a lot of talk about the conversion and enrichment components. I know we're going to talk about that a bit more later. But if I could give you an example of in the UK, for example, one of the main retail trading apps, Free Trade, they take requests from their users as to what stocks to put onto the platform. And recently they had URNM list up on their platform, the world's largest uranium ETF. So I guess we'll take it in two sections. The first one, for us to get to kick into that maybe third or fourth inning of this cycle, institutional capital really needs to play a more prominent role. We have seen that financials are dominating the spot market now. And then on the retail side, it was interesting at the sort of back end of 2021, we saw really high levels of retail participation in the market. Prices were up 40% across the sector. And really, this resulted in quite a harsh correction at the end of the year. What we're seeing now is when prices move, we're definitely seeing a more stable, higher base in pricing. It feels like this sort of quick cash has been flushed out of the sector. And while retail will definitely play its part in this next cycle, if we take what happened in 2007, there was really a 2-year period between 2005, 2007, where spot prices were at about $25 a pound, and these doubled to $50 a pound within a 2-year time frame. If we were to take that, and you always want to be cautious to try and mirror that, if we were to take that example, we're probably 18 months into that 2-year period. That was just before prices hit $136 a pound. So I'm not saying that we're there yet, but the more educated institutions become on this trade, and the more they realize the sort of asymmetric potential of this trade, it will really kick us into that next stage, I think.
Okay, that was a great overview. That's some great points in there for everybody. So as you've been saying, of course, there's a lot going on in the market, and I want to hone in on what's going on demand first. So you mentioned the utilities, which people always have a lot of questions about. The market is very opaque, and I wondered if you could go into a little bit more detail there. My impression is that we've seen this contracting begin, but what do we know about what could be next?
Yeah, it's been probably the most talked about topic. As I said, this was meant to be the year, and it really is the year of term contracting. Pretty much every utility across the board for several years was reducing their inventories. Post Fukushima, the market was flooded with material, and really utilities tried to reduce that sort of excess overhang. I think two things on this. The first thing is UXC recently put out a publication saying that the era of excessive inventory overhang is finished. The spot market used to be a safe haven for utilities to go and seek supply. They could dip in and out and take their £100,000, half a million pound clips whenever they needed. That's really not the case anymore. Primarily, one of two reasons. First of all, the financial presence in the spot market has evolved into this. They've really become the biggest players in the spot market. The second factor is the sort of international sequestering programs by China. I mean, we'll talk about it more a little bit later, but China and India are sequestering millions and millions of pounds in the market. And then I guess the second point is that the timeline that maybe the financial industry operate on, let's say quarter to quarter, biannually, it's really very, very different to the timelines that utilities operate on. Constellation, for example, they contract 6 years out. And as I said, Kazatomprom are taking on preliminary discussions for contracts through 2035. If you want to go into the numbers of it, broadly speaking, European utilities have got about 2 years of inventory left compared to North America, about 1.5 years. I believe that the sort of recommended inventory timeline that you should have is just over 2 years. So we are starting to fall short of that. And I do want to reiterate something that Per Yander at WMC said. WMC are the fuel brokers to Sprott. He said that the financial industry can sometimes underestimate just how clever these utilities are. They've been doing it for a really long time. And I think that the financial speculators in the market are really waiting for that boom or bust moment. That they look at what happened in 2007 and they think it's going to happen the same time again. It's going to happen the exact same time, the exact same way this time round. And I'm not sure that's the case based off what he had said. And he has a much deeper insight perhaps into the utility perspective. But it's basically this idea that very few, if anyone in this industry panics. Understanding the cost of not having security of supply for these utilities, one of the main points of the uranium thesis is that the cost of fuel for utilities represents around 3 to 5% of their overall costs. And the cost associated with shutting down those plants is hundreds of millions of dollars. So the fuel buyer will only get in trouble for not securing supply, not for the price that he pays for it. So demand for uranium is completely price inelastic. They will just as readily pay $140 a pound as they did in 2007, as they will $50 a pound, as we're seeing now. But I do think that what we expected is really being shown now, which is that term contracting volumes are up. Utilities are going to have to start to increase their inventories over the next 12 to 18 months. And we now know that they can't go to the swap market for that. So, later on we'll talk about pricing, but the only way that you supplement that deficit is through primary production. And right now prices are not at the levels that we need, at least that Western miners need, to incentivize them to bring operations back online.
All right. So again, great points that you're bringing up. Thank you for that. When we're speaking about demand for uranium, I think another important point to bring up is changing attitudes toward nuclear energy. We've had the Russia-Ukraine war really bring this energy crisis into focus, and it seems like nuclear is really emerging as part of the solution, at least. So I wanted to ask you about these changing attitudes and some of the most important shifts that you've seen so far.
Mm-hmm. Well, I mean, after what was a pretty quiet summer in terms of what was happening in the equity space, the news that Japan was bringing their reactors back online was really it was a massive catalyst for the sector. Prices moved up 15-16% on the day across the sector. And in terms of when you talk about sentiment, previously, let's say at the end of last year, the most notoriously anti-nuclear countries in the world have pretty much all pivoted on their strategies. Germany has put it into discussion about keeping ISAR-2 online. California with Diablo Canyon, extending that 5 to potentially 10 years. And Japan, which was one of the biggest nuclear powerhouses in the world, and really took offline all of their production, all of their reactors post-Fukushima, now has one of the most aggressive nuclear strategies in the world. So I think that really tells you about how the sentiment in the industry has changed. If we take what's happened in the Ukraine, for example, I think that you can say, at least to this point, and I do touch wood, that you can say that nuclear reactors could withstand the brutality of war. We have seen aggressive conflicts around the Zaporizhzhia plant in Ukraine, and it really has withstood what has been now 7 or 8 months of combat. In terms of the education, for me, whenever anyone talks about the risks of this trade, point number one is always the risk of a nuclear attack. For me, these are black swan events, and touch wood, of course, that these never happen. But really, the main barrier is education, in my mind, and it's people's understanding, maybe misunderstanding of nuclear as a whole. You only need to look back at Texas last year with blackouts to understand the enormous benefits of non-intermittency. Nuclear really presents this incredible zero carbon solution, which will run 24 hours a day, 7 days a week, irrespective of the sun shining or the wind blowing. And I think people are starting to understand that. I mean, in the UK, for example, there's been massive support from our government, both from our previous Prime Minister and our current Prime Minister, around SMRs and advanced nuclear, especially with Rolls-Royce's involvement in scaling that production out over the next few years. I think also the idea of SMRs were really this sort of prophecy as opposed to something that would actually happen. And then we see NuScale go public on the American markets, and it really becomes real. And these guys are signing real contracts now to make real reactors, and they're not 20 years away or 15 years away. And in the US, the sort of bipartisan support now for nuclear, for bringing in strategic uranium stockpiles, $4.3 billion promised by the Biden government for enriched uranium product. And without going off on too much of a tangent, the US has produced no uranium now for 2 years. It's the biggest consumer of uranium. Nuclear contributes to 50% of their of their clean electricity, about 20% of their overall grid electricity. And they produce no uranium, and they really need to bring that back to the West. They need to bring domestic production back online. As I mentioned, that $4.3 billion of uranium, the sort of prerequisites of that is that it can be mined anywhere in the world, not Russia, but it can be mined anywhere, but it needs to be converted and enriched in the US. And I know that we're going to talk about that in a second, but this is something that the US basically for years just become completely reliant on cheap Russian nuclear fuel, and they're sort of starting to pay the cost for that now. And just the final thing on the attitudes towards nuclear, uranium and nuclear now has almost a religious following. Although I may be on the uranium trade, for example, there's not so many people. The people that follow uranium as a trade, they really, really know what they're talking about, and they've done their work. I mean, I know that there's this new film coming out around nuclear, which everyone's pretty excited about, but my boss would always say you could fit the number of people interested in uranium maybe 4 years ago in a phone box in London. And I was just at the World Nuclear Conference in London. There was 600 people there. There was 500 people at the gala dinner the night before. And it was really interesting to see how that has evolved over the 3 years that I've been covering this space. It's really interesting to see how that's evolved. And you listen to people that have been covering this space a lot longer than I have, and they're just overwhelmed at the attitude and the change in sentiment towards this industry, uranium and nuclear as a whole. And it's really going to drive us forward into that, as I said, into that fourth or fifth innings of this cycle.
Yeah, so some good themes here. If we're talking about, education as well as changing attitudes, one thing that I think has been coming up this year for sure is conversion and enrichment. And definitely it seems like there's way more awareness right now that so much of that is happening in Russia. So I wanted to ask you to talk a little bit more about that and what people should know, because that seems to be a situation that we need to work on solving if we're going to move towards supply chain security.
Yeah, it's been the most discussed pinch point in the market over the last year for sure. Probably conversion slightly more so than enrichment. The shame is that there's not many public plays in this, in terms of there's not many ways to invest in the enrichment and conversion space. We did some pretty comprehensive work on the enrichment side, so I guess I'll start there. We did a sort of cross-reference between Centrus in the US and Silex Systems, which is an Australian listed vehicle. They're pioneering third-generation laser enrichment technology for the production of not only U3O8, not only for UF6, but for HALEU as well, for advanced reactors. And they have the potential to become a top 5 uranium producer globally of EUP. And then you have Centrus, which used to be USEC, and really they don't actually enrich anything. They rely on 10x in Russia for about 50 or 60% of their enrichment capacity. That's a huge problem, because pretty much all of the EUP that was coming into the US from Russia was going via sort of Centrus and 10x as a broker. But as I say, I use that word broker. Centrus really are just, in my mind at least, just a broker, and their main source of IP is their location, the fact that they're in the US, and have really relied on 10x for quite some time. But as I said, on the conversion side, the reason why it's become such a pinch point is because there's not much flexibility in terms of capacity. There's been discussions around the US looking to obviously bring this in-house. This is not easy. Metropolis coming back online, but these are processes that take a certain amount of time. Even just bringing back online capacity, despite the idea of having to bring on primary production of conversion and enrichment, building these facilities, getting them licensed, getting the manpower to do it, employing people to work in enrichment for uranium, there's going to be some serious sort of background checks into those people, because you're handling class 7, what would be deemed as class 7 material. I do want to reiterate something though, which was said to me by Andre Liebenberg at Yellowcake, which was this idea that it's a commercial and it's an industrial process. It's not a resource problem, and these problems can be resolved down the line. The technology is there. It's been proven previously gas centrifuge enrichment, and now just pure centrifuge enrichment. The technology's there, and again, it's just going to take time for this production to come back online. But it's certainly conversion has been spoken about as the main pinch point.
Right. And when we talk about supply chain, I know you at Ocean Wall have been doing some work looking closely at Kazatomprom's supply chain situation. So I wondered if you could go into that a little bit, because that's not something that I have been hearing too much about.
Yeah, we sort of moved away from the conversion and enrichment components and really took a deep dive into Kazatomprom and their supply network. It's called Uranium, and it's New Silk Road. It's on our website, oceanwall.com. And it really discusses in detail this trans-Caspian route that Kazatomprom have spoken about. 50% of the Kazatomprom exports currently go through St. Petersburg. And I do want to make it clear that until a point where Rosatom are sanctioned, they can continue to use this route. The story sort of started off back in 2018 with the Russian World Cup, where Class 7 cargo was prohibited from going through St. Petersburg. So Kazatomprom were forced to look elsewhere and to try and find some alternative routes, not through St. Petersburg. This was the birth of their Trans-Caspian route. This goes from their mines in Kazakhstan to the port of Aktau in Kazakhstan. It then takes 2 days to get down to Baku in Azerbaijan. It then is 4 or 5 days by rail up to Poti in Georgia, and then it begins its 13,000 kilometer journey to the west or to France. That they go via the Bosphorus Strait in Turkey, but these processes, they really do take so much longer. Instead of just going from Kazakhstan to Russia and straight across to the west, they're going through not only multiple countries, but they're going through conflict zones now with what we're seeing between Azerbaijan and Armenia. And I guess what we concluded from it is that if Rosatom were to become sanctioned, this is, again, it's the same idea as conversion and enrichment. You can't just flick a switch and start using that Trans-Caspian route. And they have huge problems in terms of volume. And again, I want to reiterate that Kazatomprom have displayed complete resilience throughout the year. They have had timely deliveries. They've shown creativity in their ability to expand their supply chain. But volumes coming through these routes at the moment are really, really, really limited. And it's about 16% of their total production. So what we did was we were sort of thinking about the proximity to China, coupled with the Chinese nuclear growth story. And for Kazakhstan, they would just have to go from Kazakhstan to China, not cross any international borders. And there's a Alishanku warehouse, which is the Chinese strategic uranium warehouse on their sort of western border, on the Kazakh eastern border. And at the current rate of Chinese procurement, we could see 800 million to £1 billion of uranium sequestered from the market into the long term. The Chinese are the only country in the world who had the ability to build 8 nuclear reactors a year. This is notoriously the slowest moving sector in the world. It takes 20 years and these projects come in way over budget, billions and billions of dollars over budget. But China are really pioneering this transition to towards nuclear energy. And our conclusion was that it makes a lot of sense for Kazatomprom to really focus on that for now. In terms of its export route, it's so much easier, much faster. They don't have to deal with the geopolitical risk associated with going through the Trans-Caspian route or through St. Petersburg. I mean, just on the financing front, they've gone from having that commercial route to St. Petersburg, and they would normally have that insured on a fixed cost throughout the year. They're now having to insure that on a case-by-case basis. And they've said that insuring cargo through the Black Sea has also become difficult, although not nearly to the same extent as Russia. One of the potential solutions to that, if we were going to stick with the idea they were going to keep exporting to the West, was using Turkey. Turkey, they have a railroad down to the port of Mersin, which is able to handle Class 7 cargo. But again, Turkey have never handled uranium before. They've had plans for nuclear build out since the 1970s, and only next year are they going to have their first reactor online. So they really have no experience in handling uranium. And from the discussions that Kazatomprom have had with Turkey, the belief is that they're not going to be able to do sufficient volumes, number one. Number two, if they wanted to use the rail network, it's not really the main form of logistical transport in Turkey. It's mainly trucking. And so they really are restricted in terms of options, in terms of getting out to the West. But again, to reiterate, they are able to use St. Petersburg until Rosatom is sanctioned. But if you're an investor looking in that space, it does come with a certain level of risk. But I'm actually heading out to Kazakhstan for 4 nights at the end of October to go and see their mines. And I really just wanted to, I really want to see firsthand. This is a country that is considered the second largest ally to Russia after Belarus. They've sent humanitarian aid to Ukraine, probably not in the best books of Russia at the moment. But again, they've really delivered in terms of they've not really missed any delivery dates. Yes, there have been some delays out of their Inkai mine to Cameco, but for the most part, they've shown great resilience throughout what's no doubt for them been a very difficult period.
Great. Okay, that'll be really interesting for you to go take a look at what's going on there.
Mm-hmm.
So we've been talking about kind of the broad situation in terms of demand and supply when it comes to uranium. We talked a little bit about price at the beginning of the conversation, and I want to come back to that. So you were mentioning that the trajectory is not likely going to be similar to what we saw during the last uranium bull market. So can we talk a little bit more about what all of this adds up to in terms of prices?
Yeah, and I do want to make clear that it could happen. I just think that it's almost become an expectation among uranium investors that it will happen. The first thing that I learned in this industry was that nothing ever moves fast. But then I didn't realize they were talking about nuclear, not uranium, because when I looked at the uranium price charts, it tends to move pretty quickly. We have our own internal forecasts of pricing. Spot's currently at 48.5, I believe. We think that would probably go to $75 next year, probably $60 by the end of this year. And then in terms of term contracting, around about $100, $90 to $100. This is really precedent upon the idea that you need to have primary supply come back online from the West. And these incentive levels for these Western miners have shot up. I know that you've talked about this in some detail with other panelists, but it's the inflationary cost associated with their supply networks, the general cost of manpower and their care and maintenance, all of their machinery. We've seen inflationary pressure across the entire spectrum, and this has really resulted in almost a twofold increase in the break-even price for Western miners. We've seen break-even levels as high as $90 a pound. So the price needs to, in essence, double in order to bring this back online. We put it at around $75 a pound in terms of the 12-year view, because there might be some lenience in terms of utility inventories, potentially not needing it for a year. But we have it at that mid-range between sort of 50 and 100, just because we think that there will be some production coming back online next year, or primary production coming online for the first time. For example, Encore Energy are looking to go into production in 2023. Paladin 2024 in Langer Heinrich. So we believe a $75 uranium price will be sufficient to bring back online new production to some extent next year. And then in terms of the term market, utilities will have to sign contracts at above market prices, because there's going to be eventually a scramble for supply. And as I said, the fuel buyer will never get in trouble for what he pays for uranium, but not for securing its supply.
Okay, that was great. And of course, we want to look at this from an investment perspective as well. I know you're saying uranium investors are a pretty smart bunch. I did want to ask, when you are looking at uranium stocks at Ocean Wall, what are you looking for? Where do you see opportunity?
Yeah, I think just to answer that broadly, first of all, is that with some of the institutional investors that we speak to, they kind of don't want to hear about the picks and shovels play so much as they just want access and exposure to spot. So I think if you take that as a first derivative, we are incredibly bullish on the spot price, first of all, at which point you have Sprott, you have Yellowcake, but investors as they sort of develop their understanding towards this, they're going to want to have a look at the names that provided this convexity back in 2007, for example. So Paladin was 15x back then, Cameco was 4x. And again, when the spot price rises, if you are a sequesterer, what was worth Y and the spot price doubles is now worth Y times 2. That becomes incredibly attractive to people. That idea of this arbitrage play on the spot price. And we've been asked and we've looked at building demo portfolios for hedge funds who want exposure to this space. And the truth is that in 2007 there was 600 publicly traded names. The market cap of the whole sector was $150 billion. You don't have much choice now. There's 69 or 70 names in the entire space. The market cap of the entire sector is a fifth of that now at about $33 billion. So, the ETF weightings towards this is 50%, let's say, towards Kazatomprom and Cameco, the two largest producers in the world. They put away 20% towards the sequesterers, Sprott and Yellowcake, and then they sort of they'll leave the rest for the developers and for the exploration stage companies. I guess the overall theme here is that a rising tide will lift all boats, and as the spot price moves, the actual assets of these uranium companies will improve with spot. It will bring about some incredibly attractive opportunities in terms of M&A. We've already seen with Vimy and Deep Yellow. And we expect that to continue. Really, M&A went quiet for the last 10 years post Fukushima, but again, with moves in spot, the whole industry, the whole sector becomes a lot more attractive. But for now, we are incredibly, as I said, we're incredibly bullish on the spot price. But there's some amazing options out there on the development stage and the exploration stage for some of these companies. But we are bullish on the sector as a whole.
Okay, that was a great, I think, overview of what's going on in uranium. As we're wrapping up, I just wanted to ask if you had any final thoughts that you would leave our investor audience with. Maybe let us know again where they can find you to learn more if they want to.
Yeah, we are at oceanwall.com. We're also on Twitter, and I'll leave my email in the comment section if anyone would like to be added to our mailing list. We put out a weekly publication. We also have a larger report, which is our case on uranium. We have our transport report, and we do some individual equity analysis as well.
Okay, well, perfect. Thank you so much for joining me to go over what's going on in the uranium market. It was great to have you.
Thanks very much for having me, Charlotte.
Great. And once again, I'm Charlotte McLeod with the Investing News Network, and this has been Finegold with Ocean Wall.